This channel is for educational purposes only. You and you alone are responsible for your investment decisions.
In honor of President Jimmy Carter, the market's going to be closed this Thursday. So we have a short trading week, just 4 days, and I wanted to highlight what I'm planning on Monday. If you were an early subscriber, you know I'm an NVIDIA bull. And when it hit 105, I backed the truck, and I've been riding that train all the way up to the top, selling covered calls, generating income, and reinvesting that. Well, unfortunately on Friday, I had to sell some. It went in the money, and I had to sell, I believe it was 400 shares. So now I'm sitting at about 60 grand in cash. I'm going to redeploy that on Monday. Why? You can't pry NVIDIA out of my dead hands. How am I going to set up that trade? Tomorrow I'm going to pull up the NVIDIA option tables. I'm going to find a strike price that's about $2 less than the current trading price. I'm going to sell to open 3 to 4 puts, and I anticipate making at least $1,000 to do this. Expiration on Friday. Let's get real and talk about the 3 possible outcomes of this trade. So number 1, NVIDIA, let's say it grinds sideways, it goes up, it stays above the strike price. What that means is this option on Friday at market close will just disappear, and I get to keep the original option premium. I can invest that, I can spend it. It doesn't really matter what I do with that. That's mine to keep no matter what. Second possible outcome, there's fear in the market. People are flipping out, NVIDIA's crashing. Well, I've agreed to buy it at a price that's a couple dollars less than it was currently trading. So I get my shares back, 300 or 400 shares, depending on if I sell 3 or 4 puts. Now I own those shares. I bought them actually at a price lower, right? Because I set the contract up a couple dollars lower, plus I got the option premium. So my cost basis is actually lower than if I just pulled the trigger at market open. The third possible scenario is option premiums do not stay static. They change based on the level of risk and the time. So, for example, I've had scenarios where I sell, say, 3 or 4 puts. I make about $1,000. And as the market either goes up or down, and that underlying stock goes up and down, I set limit orders up to buy it back at a lower price and make the difference. So say I got 1,000, 4 hours go by, the stock's going up, I look at the option table, I can buy it back for $400 and make the difference. So it depends how volatile things are getting, and volatility in a lot of cases is good with this method because you can enter a contract and then eliminate risk and bank that money.